Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. President Trump calls for Iran's unconditional surrender as speculation grows that the US may join the conflict in the Middle East. Oil trends higher, then adding to gains of close to 10% since Israel launched its attacks last week. Plus, the Fed expected to hold rates steady as President Trump's trade policies cloud the outlook. But traders pile into bets that the next Fed chair will slash US interest rates in 2026. So the Middle East on edge. If it wasn't on edge before, it certainly is on edge now, with speculation that maybe the US joins the fight alongside Israel against Iran. That decision has yet to be made, but the reporting suggests it is being weighed up by President Trump. European futures pointing to losses of 0.3%. You saw some downside pressure across the European and US equity markets yesterday. European stocks ended lower by 0.8%. A similar picture for the S&P 500. The Nasdaq 100 dropped 1%, wiping out the gains, essentially, of the day previous. FTSE 100 futures here as we look ahead to inflation data crossing at 7 a.m. UK time, currently pointing to very modest gains of 0.1%. S&P E-minis also in positive territory, not by much. Nasdaq 100 futures in similar territory as well. But really, the eyes, of course, are on the decision from President Trump when it comes to the Middle East, and, of course, what the Fed, particularly Jay Powell, has to say following an expected fourth straight hold for the Federal Reserve. 440 right now on US benchmark 10-year. Worth noting that the data that came through yesterday, particularly retail sales out of the US, was weak, slumping, in fact, to the lowest level in terms of the biggest drop in retail sales since the start of the year. 2 straight months now of falling retail sales stateside. 440 right now on the benchmark US 10-year, 145 on the Japanese yen. Exports out of Japan softening, raising the risks of a recession in that country as it grapples with those Trump tariffs. Brent at $76 a barrel right now. This remains, of course, the asset class to watch, given the ramped-up tensions in the Middle East, largely unchanged in the session. But as we said, up about 10% since Israel launched those attacks on Iran last Friday. Gold, the yellow metal, getting a bit of a bid, up 0.1%. So Donald Trump has held talks with his national security team, fueling speculation that the US is about to take a more active role in Israel's military action in Iran. Bloomberg understands yesterday's meeting in Washington lasted more than an hour and was followed by a call with the Israeli Prime Minister. Earlier, the US President had posted on Truth Social calling for Iran's unconditional surrender and that America's patience was wearing thin. Let's bring in Bloomberg's Germana Pesechi in Dubai. Germana, what are Donald Trump's options at this point?
Well, Tom, ever since President Trump left that G7 summit early to focus on the geopolitical situation in the Middle East, that has been the number one question. What are his options here? What is he thinking? Can we get insight into what is going on in President Trump's mind? We know that we had this reportedly 1-hour meeting with his national security team in Washington. There was no statement put out afterwards, so unclear what was discussed in that meeting. He also had a call with the Israeli Prime Minister Netanyahu. No readout of that call either. But at this point, there is a lot of focus on some of the posts that he put out on Truth Social yesterday. And not only because of the content of what he's saying, calling for Iran's unconditional surrender, suggesting that the U.S. know exactly where the Ayatollah is, but for now he's safe. However, lacing that in with a threat if Iran don't yield to the U.S. terms, but also using the plural term we, suggesting that the U.S. are somehow already involved or even tacitly participating in the Israel campaign against Iran right now. So his options at this point are, do they get actively militarily engaged as well? Do they start really deploying U.S. assets and aiding actively Israel with these airstrikes and attacks on Iran? Or do they push for the diplomatic channel and try to bring a now weakened Iranian regime with weakened military and defense capabilities, in addition to nuclear capabilities, to the table and try to get them to agree to terms? As previously discussed, the sixth round of US-Iran talks were supposed to take place on Sunday. They were cancelled. In the meantime, the hostilities between Iran and Israel continue. More attacks overnight. The death toll in Iran hasn't been formally updated, but some human rights groups are saying that the death toll has climbed to more than 500, of which about 100 constitute security personnel, some of those senior commanders. In Israel, the death toll official figure is still sitting at 24. Of note, though, Tom, as well, the U.S. Embassy in Jerusalem is now closed for 3 days.
OK, so the conflict, of course, continues, and President Trump, as you say, weighing up what could be a monumental, potentially historic decision. What have other world leaders been saying about this conflict, about this war now, Jemima?
Yeah, well, you have to remember President Trump, on both his first term and his second term, talked about ending the quote-unquote forever wars in the Middle East. He spoke about that when he was in Saudi Arabia just a couple of weeks ago. But it's interesting to hear that some other leaders around the world are a bit more cautious, namely because they are beginning to draw parallels between the decision to attack Iraq back in 2003 and the chaos that unfolded in Libya after military intervention there. Take a listen to what President Macron said on the sidelines of the G7 summit last night.
No to military actions aimed at regime change, because no one knows what comes next. Haven't we collectively seen the consequences this has had in the region and beyond? Does anyone think what was done in Iraq in 2003 was a good idea? Does anyone think that what was done in Libya last decade was a good idea? No.
So the international community agreeing that Iran shouldn't develop the capability of an atomic weapon or a nuclear weapon, but at the same time saying that going one step further and trying to push or externally force regime change doesn't have good results if you take other episodes in history where that has happened in the Middle East, including, in this example, President Macron talked specifically about Iraq and Libya, which is why many of the countries in the region, Arab states, the likes of Qatar, Oman, Saudi Arabia, all of them are pushing for mediation. They're pushing to restart those diplomatic channels, condemning the acts that Israel and the actions that Israel have taken only 6 days ago, and saying that at this point, that what they did, the military aggression, actually violates the principles of the Charter of the United Nations. So there is a bigger consensus of countries out there pushing for a diplomatic solution, looking to bring down the temperature, and others going as far as President Macron suggesting that if you push too hard on regime change, it could have ultimately undesired consequences and potentially even lead to chaos.
OK, Bloomberg's Jemima Fasechi in Dubai with that important update, of course, out of the region. Jemima, thank you. To the oil markets now. Oil holding on to the gains, of course, made since Israel began its attacks on Iran on Friday. Crude is now trading near a 5-month high on concerns the conflict will escalate. Let's get more from Bloomberg's Middle East energy markets reporter Anthony Di Paola, who's been watching this in great detail since, of course, the start of the conflict for us. Anthony, what is your analysis, your assessment right now of the oil market adjustments around this, with Brent up just 0.2%, but at $76 a barrel in the session today? How much risk premium is priced in at this point?
Good morning, Tom. Yeah, I mean, what the risk premium that you'll see is that almost 10% increase that you've seen that you mentioned since the assaults started on Friday the 13th. And we did see a big jump at the start of trading this week when we had those first initial attacks on some energy infrastructure in Iran, albeit those were domestic facilities. So we have seen that that risk premium built in. Arguably, there was some risk premium already supporting prices anyway, as a lot of traders were saying that prices could have been lower than the roughly 60 to 65 range that we'd seen before this because of some of the tension here in the region. But at that kind of $75 area, where market is really not signaling that they're concerned about an interruption in supplies. So the market is hedging its bets for a little bit, but really we are in completely uncharted territories because we are in the first time where there's this massive state-on-state conflict between countries like Iran and Israel. Just think about what Jumana was speaking about before, where we're kind of parsing social media posts from the president to try to figure out what U.S. policy is going to be. So it's really a lot of guesswork here. The signals are, of course, if there's more U.S. military equipment coming into the region, if Trump is speaking with the security team, that signals there could be more escalation. But this goes completely against what some of Trump's base and some of his domestic supporters want, and I think against his intent in terms of avoiding war. So we really have to see whether he's going to take that step to make a major escalation. And from Iran's point of view, they clearly want to avoid that bringing to bear of more military force by the United States on them. So the question is, would they lash out, even if the U.S. is supporting Israel with arms and with some support? Would they lash out against bases that would then bring the U.S. in? So we're really in uncharted territories in trying to figure out how this is going to happen. Will cooler heads, as it were, prevail in terms of keeping the conflict confined at least to those two states, or will it spread out? And that's where the real risk comes in for the oil market. If that spreads, if there's any interruption of supplies, if it spreads to other producing countries in the region, which those countries here are really at great pains to avoid. So that's really a lot of things that the market has to take in. But right now, they're not signaling concern about supply, Tom.
Okay. Anthony Di Paola, thank you very much indeed with an update in terms of the oil markets and how they are adjusting to all of those uncertainties emanating, of course, from the region. Anthony, thank you. Now, Fed officials are widely expected to leave interest rates unchanged for a fourth straight meeting later today, with President Trump's trade policies adding to uncertainty around the economic outlook. For more, let's bring in Bloomberg's Valerie Teitel. Let's give us a preview then, Val, in terms of what to expect, what you are going to be watching for when it comes to the decision from the Fed, and what to expect to hear. We're going to hear from Jay Powell, and to what extent that may ire and irk further President Trump.
Yeah, exactly. I think this decision is really going to come down to a lot of nuance. That seems to be the base case. People are expecting to see a hawkish dot plot. So the Fed penciling in less cuts for the remainder of 2025 than they did previously. But that'll be tempered by a dovish press conference by Jerome Powell 30 minutes later. Now, the updated projections, I think, are really going to be the key signals here, both in terms of how many cuts they pencil in for next year, but also their inflation forecast. That's going to be the important one. How are these Fed officials thinking that tariff-induced inflation will hit the economy? And do they see it as something that's possibly transitory and they could still cut into rising inflation? Or perhaps does that mean that they are penciling in no cuts for 2025? I think that will be a very interesting thing to watch here, Tom, just how many Fed members pencil in no cuts for the remainder of the year on the back of maybe a revised higher inflation forecast for the remainder of the year. Powell is likely to repeat many of the same words from the March meeting when they released their last round of projections, saying that the monetary policy is well positioned to wait for further clarity, really stressing that they might not have clarity on inflation until later in the summer, possibly until September. So this is going to be another message from Powell that the Fed is on hold until they get more clarity of the tariff impacts on the U.S. Now, one thing that is not waiting for further clarity is what traders are penciling in actually for next year when it comes to the new Fed chair expected to sit down in May 2026. We're already starting to see traders position for an uber dovish Fed chair, possibly someone sitting down at next May and slashing interest rates drastically. That's a very interesting thing to watch. Whether the market is going to continue to listen to Powell if perhaps President Trump picks a next Fed chair sooner rather than later. Yeah,
potentially a lame duck Fed governor alongside an incoming Fed governor could be challenging for the markets in terms of who to listen to. There's also been some changes announced, at least proposed changes around capital rules for banks. How significant is this?
This is a widely anticipated reform. I feel like we get a leak about this every other month. This is all about easing bank capital rules on the U.S.'s largest lenders. And this is something that is maybe a key platform of Trump's economic agenda. Pushing for bank deregulation was something that business leaders wanted to see come out of the Trump administration that maybe we haven't yet. The one thing here, Tom, that I found notable is sources were saying that there is no direct exclusion or carve out for treasuries in this current plan. And I think that's something that those hoping to be bullish on the treasury market were wanting to see. I think many people are pointing fingers to these tight capital rules on treasuries as to what caused the illiquidity in the treasury market back in April, and thinking that if this is slashed or treasuries get a complete carve out, it would really aid liquidity in the treasury market. There was nothing in this current plan, but the Fed does meet next Wednesday to discuss this. And there was some speculation that regulators might ask for public comment about the treasury market reform. So kind of hinting they've not necessarily made a final decision.
OK, Valerie Titel, thank you very much indeed with a preview of the Fed and, of course, some of those changes potentially in the pipeworks for treasuries and capital requirements for banks. Coming up, Canada's Prime Minister calls for maximum pressure on Russia as he announces more support for Ukraine. We bring in the details from the G7. That's coming up after the break. This is Bloomberg. US President Donald Trump has resisted G7 calls to impose new sanctions on Russia, despite urging a ceasefire in Ukraine. However, Canadian Prime Minister Mark Carney unveiled new measures to support the country, including $1.5 billion in military support for Ukraine.
We underscored the importance of using maximum pressure against Russia, who has refused to come to the table. The president has led unconditionally to come to the table in search of peace. And maximum pressure includes financial pressure.
OK, let's bring in Oliver Crook from Berlin, who's been following everything out of the G7 for us. So G7 leaders, Ollie, they could not convince Trump to impose tougher sanctions on Russia. We know those sanctions have been worked up. We know that the bill is sitting there. That we know that the Senate has put these forward. It's ready to go. It's kind of oven baked for the president. What is the explanation for why they are so reluctant, the Trump administration, to pull the trigger on additional sanctions on Russia?
Well, the reason that the Trump administration has given in the form of Donald Trump himself over the last few days is that basically sanctions cost the United States quite a lot of money. This is the point that he made over the last couple of days at the G7 meeting. But of course, he also had a birthday phone call with Vladimir Putin on Saturday. He did say that when he spoke to Putin over the weekend that he would like to see the war in Ukraine end. But there hasn't been that sort of impetus, that maximum pressure campaign from the Trump administration on Putin. As you know, the Trump administration and Donald Trump has really often seen Zelensky as the obstacle to peace as much as Vladimir Putin. But what the EU and the United Kingdom would have liked to have done at this G7 meeting is to get Trump not necessarily to impose his own sanctions, but to join the EU and the UK in lowering the oil price cap that already exists on the seaborne Russian crude oil from $60 a barrel to $45 a barrel. They sort of soft floated that idea. And when it became clear that the United States and Donald Trump basically had no interest in that, they basically sort of abandoned that proposal. And of course, this comes at the same time, Tom, when you had over the last couple of days Donald Trump talking about how basically it was the G7's fault that the Russian invasion of Ukraine happened in the first place, because if it had been the G8, if it hadn't been for Barack Obama and Justin Trudeau, he says, expelling Russia from the G8 forum, the invasion would never have happened. Of course, the reason that Russia was expelled from the forum was the initial annexation of Crimea back in 2014. But again, these are the sort of tensions that were flaring up within the G7. And as we know, the Trump administration is not really a fan of joining on to other people's proposals on sanctions. Either the U.S. is going to move on its own and have others follow. It's not going to follow others into that sort of conversation.
Yeah, just minor detail in terms of the invasion, of course, of Crimea. Look, you've talked about, Ollie, you've followed this very, very closely. You've been on the ground in Ukraine for us. Carney stepping up support, so Canada putting more money into the bucket for Ukraine. Is this how it works now? It's individual countries are going to have to step up with their own support for Ukraine?
I think that increasingly, yes. We know from the very beginning that the Trump administration basically does not want to take a leading role in terms of military and financial support from Ukraine. He has made that very clear on the campaign trail. It is very clear in the sort of so-called Trump foreign policy doctrine. So you're going to get more bilateral agreements if Ukraine is going to get more support. And what we got is exactly that from the G7 summit in the form of Mark Carney, who delivered $1.5 billion US dollars worth of military support to fund Ukraine's war efforts. He wants wants to put more sanctions forward on the Russian shadow fleet, because of course the oil price cap does not really apply to the shadow fleet, because by definition the shadow fleet is operating outside of the rules of the sort of Western-led order. So those are kind of, freewheeling ships across the seas. And, Carney calling for maximum pressure campaign on the Russians in order to bring them to the negotiating table, something that so far has failed to happen. And of course, we're talking more and more, Tom, about this idea of coalition of the willing as the G7 sort of framework sort of begins to sort of disintegrate. But I think that that's the fundamental question going forward, Tom. In addition to sort of what's going on in Ukraine, this global order led by the United States historically, this framework established by the United States, now as the United States walks out of it, who is going to lead that order? And that is going to be, I think, Tom, the fundamental question for the coming months and years. And it's the question we're going to put to the leaders that we speak to next week at the NATO summit, where everybody is going to be basically performing for Donald Trump, trying to say why NATO is still relevant and why the United States should still stay committed to it.
OK, Bloomberg's Oliver Crook, thank you very much indeed, with a nod as well to that important, of course, NATO summit next week. Meanwhile, Italian Prime Minister Giorgia Meloni is pushing G7 leaders to support a ceasefire in Gaza amid the escalation of hostilities between Iran and Israel. Meloni says she's found agreement with many of the leaders she's spoken to in recent days. Meanwhile, in Gaza, AP reports figures from the health ministry that at least 51 Palestinians were killed and more than 200 wounded while waiting for UN and other aid trucks. The Israeli military acknowledged, quote, several casualties as they opened fire on a crowd and said authorities would investigate what happened. Russian President Vladimir Putin's top security aide has met with North Korean leader Kim Jong-un in Pyongyang. The visit by the former Russian defense minister comes after reports that North Korea plans to send more military personnel to support Moscow in its war in Ukraine. Coming up, we're going to switch focus. OpenAI Sam Altman says Meta has been offering signing bonuses of as much as $100 million to poach top talent. More on the increasingly expensive AI talent race. That's next. This is Bloomberg. OpenAI Sam Altman says that competitor Meta has offered some of his staff signing bonuses of as much as, get this, $100 million as the race for AI talent ramps up. Charlie Wells is here with the latest. I don't think necessarily Charlie has been offered one of these bonuses, though. Maybe he should have. Talk to us about the money that is being dangled right now in front of this AI talent.
Yeah, so the figures are astronomical, and there is a way to make sense of this, though.
Is there?
And I'm going to use the acronym CDT. Chips, data, talent. So those are the three pillars of AI development. And basically, you can kind of make sense of what all of these different AI firms are doing based on where they have weaknesses in those areas. So if you think about Meta, they have got the chips. They most definitely have got the data. But it's the talent where it's seeming like they're needing to pick up pace a little bit. And this is what you're hearing Sam Altman talk about on this podcast with his brother. He called these signing bonuses of as much as $100 million crazy. But some executives have even told Bloomberg that these could make sense, right? Because there are just so few people in the world who have these sorts of skills. And basically, Mark Zuckerberg has been really frustrated with the pace of Llama 4, their large language model. And so basically looking to kind of scoop up talent, poaching them from across the industry.
What's happening with XAI and the cash burn?
So, look, people familiar with the matter have told Bloomberg that they have been spending as much as $1 billion a month as they try to pick up pace. Wow. They are estimated to spend potentially $13 billion in 2025. And you can bring back that CDT framework as well to make sense of it. I know it's a little cheesy, but
we love your CDT
they've
framework.
got the talent, right, in Musk. They've got the data from from X, but it's the chip element where they're really spending a lot of money. So they are, whereas a lot of firms are trying to rent a lot of this infrastructure, a lot of these chips, XAI is spending on it, and that's where a lot of this money is going.
Good news for NVIDIA and Jensen Huang. Thank you very much indeed. Charlie Wells wrapping some of the AI stories, of course, for us. Coming up, we're going to return to the markets with Benedicte Lowe from BNP Paribas Markets 360, how to position amidst the Middle East tensions and geopolitics. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. President Trump calls for Iran's unconditional surrender as speculation grows that the US may join the conflict in the Middle East. Oil trades near a 5-month high with gains of around 10% since Israel launched its attacks last week. Plus, the Fed expected to hold rates steady as President Trump's trade policies cloud the outlook, but traders pile into bets that the next Fed chair will slash US interest rates in 2026. So, geopolitics in focus, the Fed decision, of course. More importantly, arguably, it's what we hear from Jay Powell about next steps. What would make them move in terms of rates, with markets still pricing in potentially two rate cuts by the end of this year. Also, the updates in terms of the forecast on inflation, jobs, and the dot plots as well from the FOMC. European futures pointing lower by 0.2% after a drop of 0.8 yesterday, so the geopolitical risk premium back in the fore again. FTSE 100 futures currently largely unchanged, pointing to very modest gains of 0.1%. US futures pointing to modest gains of 0.1% on the S&P E-minis. The S&P 500 ending the session down 0.8% yesterday. Nasdaq 100 futures looking to add 33 points. Let's flip the board and have a look cross-asset. Focus, of course, on treasuries in the lead-up to that Fed decision. Largely unchanged on the 10-year right now, just a move of 2 basis points at 440. The Japanese yen is up 0.2%. Part of that is down to dollar weakness in today's session. Brent remains, of course, squarely in focus. It's been very choppy on the uncertainty out of the Middle East. Currently down 0.5%, but as we mentioned, up 10% approximately since those attacks by Israel on Iran that started on Friday. $76 a barrel on Brent. Gold largely unchanged in the session at 3,388. Let's get more analysis on the markets right now in terms of how they are impacting or being impacted by these global events, and bring in Benedicte, Lowe, equity and derivatives strategist at BNP Paribas Markets 360. Benedicte, good morning. What is positioning telling you about the downside risks to equity markets if we get a further escalation in the Middle East?
So we're seeing at the moment positioning is quite neutral, both in Europe and in the US. And in the US, we also have the gamma positioning from dealer that is in positive territory. And that tends to cushion move on the downside. And this is actually what we saw since the start of the escalation of tension last week. The equity market reaction has actually been quite contained so far. When we look at previous episodes of tension in the regions, what we've noticed is that the risk aversion in the market tends to last for around 2 weeks, unless there is a real impact on the global economy. But otherwise, after 2 weeks, the market focus shifts away from the conflict. Vol tends to go down, market tends to rebound. Now, we're just 5 days within the start of the conflict, of the escalation of the conflict, so there is room for lower price movement, but at the moment, positioning is cushioning the downside.
And do you think that story repeats itself, even if and even in a scenario where the US joins Israel in offensive action against Iran?
Yes, obviously I'm not a political expert, but on the market side, the more global the conflict begins to be, the more negative and the more outreach impact it could have on the market. For now, the positioning has been enough to cushion the market downside. OK,
so we watch for other players potentially to be pulled in, and that could be the catalyst for more downside for equities. How much risk premium, I guess you touched on the risk premium story, in terms of how much is priced in right now. How does that lead your view as we move into the summer period with the geopolitics, this trade uncertainty that continues, and frankly, a pretty foggy picture when it comes to the central banks, particularly the Fed, maybe more clarity for the ECB, but particularly the Fed. How does that leave your positioning as we lead into the summer?
Yeah, so obviously, if this conflict escalates majorly over the next few days, that puts some risk of our view, but at the moment, we're keeping our view of range-bound market ahead of summer for Europe. This is driven by a number of factors. First of all, positioning is neutral. That means it tends to be less of a driver on a day-to-day basis. Also, we sense that there is some type of tariff fatigue in the market, where the market has just been reacting less and less to headline news, where there's been a bit of like this taco news and overall kind of fatigue. And on the upside, we do need another catalyst for stock to really break higher, whether that comes from material earnings upgrade, whether it comes from an improvement in the geopolitical situation or real improvement on tariff talk, which we are not seeing for now. So for now, until we get clear clarity on the geopolitical situation or a material earnings upgrade, we keep the range-bound view.
Okay, so we're still looking for that catalyst for global stocks. Does the European equity performance outperformance over their US counterparts, does that continue this year?
Yeah, so we've seen over the past few days that it was a bit trickier, or even the past few weeks it was trickier for Europe to outperform the US. There's been a catch-up of the US, but overall we think there is a positive dynamic into Europe. We've got the German fiscal stimulus that should help the economy. That's more a H2 or even a 2026 story that should help the cyclical story in Europe. European stocks are quite cyclical, so that should be bullish. And there's also the question of allocation of flows. We've seen over the past 10 years there's been a major allocation of flow into the US. There was this narrative of US exceptionalism, and we're turning away from that, and we're seeing that there's other alternative elsewhere. Europe is one of these regions where flows are starting to get into the regions. We think there's more potential to attract flows.
Yeah, the Bank of America recent survey, fund managers survey, came out yesterday, and that survey pointing to a view amongst fund managers that global stocks will outperform US equities over the next 5 years. You would align with that view, would you?
Yeah. So, I mean, end of year type of horizon. This is what we have in mind for this to happen. Maybe not short term. If the geopolitical tension worsen, that tends to be a bit more risk off for European stock than the US. But I mean, 6 months, 1 year down the line, there's room for that allocation into Europe to pick up and for European stocks to outperform.
Within Europe, if you lift the hood, where are you finding catch-up potential?
Yeah. So an index that we particularly like at the moment is the SMI. We've seen the index suffered after the Liberation Day with some tariffs that were announced on the pharma sector, with the SMI being overweight on the pharmas. Now, when we look at positioning, there's been large outflows out of the pharma sector. The CTA positioning is really depressed. And we're seeing that the discussion between Switzerland and the US are going quite well. Switzerland could be one of the next countries to get a deal with the US. And what we could expect is that, similar to the UK deal, when there was some exemption for autos, the auto sectors with some quota being put, this could be the same that would be on pharma, and we could see some catch-up potential for the SMI.
Okay, it's really interesting, the views on the SMI over in Switzerland and the potential catch-up given the pressure that's been on pharmaceutical stocks. But of course that does, as you say, depend on some kind of agreement between the US and Switzerland. Before we let you go, your views on UK equities. Are you constructive on UK equities? The data is softening. Do you look at the FTSE 100? Do you look at FTSE 250? Is there anything in UK equities that is drawing your attention at this point?
Yeah. So the UK equities as a whole, they've outperformed recently on the back of the trade deal that was announced by the US, but also with the geopolitical tension, the index is more weighted towards the oil and gas sector, which is one of the sectors that's performed the best since the start of this tension. So there's room for that outperformance to continue. Also, it's one of the index in Europe with the cheapest valuation, so that offers some cheaper upside. But in terms of the growth of the economy, it's not too positive. We're not seeing any strong rebound, so it's probably more a short-term trend than anything else.
Okay, Benedicte, thank you very much indeed. Benedicte Lowe from BNP Paribas Markets with views on the SMI, maybe some catch-up there and potentially further upside as well for the UK FTSE 100 stocks, given the cheap valuations relative, of course, to their international peers. Now, the author of The Black Swan says President Trump's approach to tariffs makes no sense and his economic team lacks expertise in the areas they're dealing with. Nassim Taleb, who is also an advisor to hedge fund Universa Investments, told us exclusively why he thinks Trump's signature economic policy is bad for the economy.
We need to worry because the approach is not very rational. First of all, they're amateurs doing numbers to start with. The other thing is when we have 4% unemployment, think about it, you have 4% unemployment. It means the economy, what are you going to do now with these tariffs? Try to shift business from high added value into low added value? This is what we're invited to do? Well, that will depress GDP. So in other words, it's like asking a surgeon, just for balance, to clean the streets 1 day a week, okay? So of course, it would depress GDP. That's exactly what the Trump administration is getting us to do. I understand tariffs. Tariffs may be necessary in many areas. Tariffs need to be symmetric and stuff like that. So this we understand. But the way they're going about it makes no sense.
Can you understand, the reasoning behind it? Because these are people, that Trump has around him. Scott Bessent, Howard Lutnick, Stephen Miller, who they're not idiots, right? They've done well in their careers. They went to Ivy League schools. Like, what are they? Why are they doing this?
There's a difference between, I mean, they're not idiot and they're not specialists in that area, and they're probably okay in what they've done in the past. Although
Peter
I'm not
Navarro.
sure about all of them.
Yeah.
I mean, Peter Navarro, I apologize, but I'll have to say that in his own domain, he hasn't fared well. Okay, the other ones had some kind of performance in an area that is orthogonal, in other words, uncorrelated to the current performance. It's like asking a dentist to do brain surgery. Okay, may do better than average. I'm not sure. Okay, so none of them really is a specialist of the area that they're discussing. And this is where I find myself agreeing with economists, okay, that basically it makes no sense. And the approach is irrational. You see, the idea of confronting China is irrational. But now let's think about what are going to be the effect. Well, there are two things they're doing. The first one, tariffs on things that we don't produce. I mean, it's going to tax not the middle class, but it's going to class
the poorest among us.
The poor, because
it's regressive.
And then compensating that with a tax break doesn't work if you don't pay taxes.
Nassim Taleb speaking exclusively to Bloomberg. Now, the US dollar is down more than 10% against the euro, partly tied to what Nassim was talking about, of course, the pound and Swiss franc. Since Donald Trump, so down about 10% versus the pound and Swiss franc, since Trump began his second term as US president. In fact, it's down against every single major currency in the world. Today's Big Take examines the effects of Trump's policies on the exchange rate and the greenback status as the world's reserve currency. Bloomberg's Valerie Teitel is here with more in terms of the details. And Val, you've been squarely focused on the dollar since, of course, Trump came in. Well, prior to that as well, frankly. But the moves have been more interesting since Trump's second term. Talk to us about what has shaken. What are the key factors that have shaken confidence in the greenback?
Well, frankly, it's disrupted one of the greatest trades of the last 20 years for a foreign investor, which is to hold unhedged U.S. stocks, namely tech stocks, because what happened in April, I think, will continue to have ramifications for foreign investors. The fact you had the dollar weakening alongside stocks was something you don't normally see. And for a foreign investor, the dollar has really worked in their favor if they're holding exposure to the U.S. equity market, because on those times that we get big corrections in the U.S. equity market, it's normally their unhedged dollar position, which kind of buffers those losses a bit, because normally we have this thing called the dollar smile, which means that the dollar is really buoyed sometimes during times of extreme stress. So, we've seen it in the last few days around the tensions in the Middle East. You had a strengthening dollar. And we've seen it in the past, alongside big equity market drops, you normally get a strengthening dollar. And the fact that this relationship really broke down in April is having foreign investors really rethink their diversification, frankly, whether they want to be this exposed to the U.S. dollar and U.S. assets, or whether they want to look to other economies for some diversification, namely, other economies around the world like the euro.
Why is the Trump administration not more concerned about this issue?
Well, look, in some way you can argue that the Trump administration does need a weaker dollar if they really want to see this manufacturing renaissance. The tariff regime and the things that Trump is trying to do is trying to balance the trade deficit of the U.S. economy. And one way you can easily do that is by having a weaker dollar. It's very hard to have a manufacturing renaissance alongside a strengthening currency. We know that from these Asian nations who, have constantly manipulated their currency to keep it weak in order to aid their exports. So in some way, maybe the Trump administration isn't necessarily bothered by the dollar's decline, but it does pose some interesting questions on whether if this continued foreign investors diversifying out of U.S. assets does in some way cause a reinforcing circle.
What are the other repercussions potentially?
They could be huge, especially when it comes to the U.S. Treasury market. We know that the U.S. Treasury market is set to reach $30 trillion in size this year. The U.S. government is continuing to spend these large deficits. And if you have foreign investors rethinking their dollar assets, they might also be rethinking their holdings of U.S. Treasuries. And that's happening alongside the same time that the U.S. government really does need an incremental buyer of Treasuries in order to fund their spending, frankly.
Bloomberg's Valerie Teitel, thank you very much indeed. That is the Bloomberg Big Take today. You can read that, of course, on the terminal and on .com. Coming up, it is UK inflation day today. We're counting down to it, just 15 minutes away. We're going to have a preview for you next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. UK inflation data is due in the next 10 minutes, expected to ease to 3.3% in the year to May. That should be welcome news for the Bank of England, which is under pressure to cut rates after a run of poor economic data out of the country. For more, I'm joined by Anna Andrade, who is an economist for us, covering UK economics, of course, at Bloomberg Economics, covering the UK economy at Bloomberg Economics. Anna, thank you for joining us bright and early in the studio. The expectation then of slightly softer inflation print in the next 10 minutes out of the UK, what is behind that?
Hi, good morning. So we're expecting a softer inflation. As you said, we are expecting 3.3% in May from 3.5% in April. But I have to say that part of the slowdown and also part of the slowdown in services is going to be driven by a fix that the ONS is going to make to its data. It sort of uncovered a mistake in the April data.
This is the Office of National Statistics.
Yes, of course, yeah, the UK statistics body. And it essentially found out that it had overstated the increase in the vehicle excise duty. And instead of revising its backward series, it's going to sort of fix for that in the May. So part of that slowdown is going to be artificial. We're also going to get sort of overall better news because some disinflation will be driven by lower airfares. They pushed up on inflation in April because of the timing of the Easter, and now that's sort of going to unwind. So overall, there's going to be some progress. The direction of travel is the right one. It's probably going to be a bit overstated by this mistake. But I would say that for the Bank of England, it's good news. But they still live in an above 3% inflation world, and that's
But I think that context around the data and how to think about it, given those changes and adjustments, is really important. Where does it lead the BOE? Markets are pricing in 2 additional cuts by the end of this year. Does that get pulled forward? Do we see more cuts from the Bank of England?
I don't think this data is going to sort of be a game changer. If it comes in line with our expectations, it won't show that much progress. We have had sort of a quarterly pace of rate cuts for a long time, and I think this is where the BOE is right now. It's true that the data since we had since the May meeting has been overall dovish. So we have the economy cooling, we have the jobs market loosening at a quite pretty, probably scary pace for the Bank of England, or probably uncomfortable pace. And we have sort of inflation sort of broadly going down. But then at the same time, if you look at the fact that inflation is above 3%, and it will stay there for the rest of the year, inflation expectations are not as anchored long term, especially, which is a concern for the BOE, as not as anchored as the BOE would like, according to the latest data. And then you also have the risks from the Middle East.
What does that oil price jump mean for the expectations around inflation?
So if you look at the movement in oil price since the BOE's last meeting, I would say it's not a game changer. It's sort of up $10 per barrel. That will add 0.1% to headline inflation, so it's not significant. But I would say there's, of course, the risk, and I think the BOE is very conscious of it, that oil price shoot up even more. And if it gets somewhere to sort of $85 per barrel, that can sort of pushed up projected inflation towards 4%. And that's really, uncomfortable for the BOE. So on the one hand, you have this sort of good news data. I mean, good news, the economy is cooling, the labor market is cooling, but there's a lot of other factors that will continue to lead the BOE to sort of exert restraint and cut sort of at a quarterly pace.
So $85 a barrel could be the pain point for the BOE, $75 right now. Anna Andrade, thank you very much indeed. Covering the UK, of course, for Bloomberg Economics. That data dropping in about 9 minutes. Time. Meanwhile, the UK government is looking to restrict the number of visas it gives to countries which refuse to sign agreements to take back migrants. Prime Minister Keir Starmer says the move is part of his government's push for more assertive measures to reduce levels of net migration. After almost a year in power, Starmer is coming under increasing pressure to devise a strategy that successfully reins in net immigration numbers that have touched records in recent years. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It is, of course, Fed Day. Worth noting that the data out of the US was grim yesterday, whether it's industrial production, whether it's the housing market, whether indeed it was retail sales. So for a second straight month, you saw retail sales falling. All of this, of course, mixed by the impact on tariffs. But what you saw was the biggest drop since the start of the year. So retail sales dropping 0.9%. Autos was a big factor in that, but also eating out. So dining and restaurants. So that part of the services economy taking a big hit as well. So consumers on the data that we saw yesterday, seemingly reining in their purchases. They've gone and bought out autos, of course, at the start of the year, or at least as we led up to and on the back of those April tariffs from President Trump. So there's a lot of pull forward when it comes to the auto sector. So maybe that is part of the mix in terms of how to think about this. But certainly in terms of your view on the consumer and the retail spend, that could be concerning as consumers pull back on some of those areas stateside. Let's flip the board and have a look at what this means, of course, for the Federal Reserve. The softer data out of the US yesterday. Markets still pricing in close to 2 additional cuts from the Fed. Let's see, of course, if that is what comes out. The dot plots, the forecasts, of course, those updates will be scrutinised, as will Jay Powell's comments on what will likely move the Fed. What will it take for the Fed to move? So the dot plots could be adjusted. You'll get the updates in terms of inflation, the updates, of course, in terms of the unemployment picture as well, in terms of the forecasts from the Fed, alongside a decision which is fully expected to hold for the 4th straight meeting. Bloomberg Terminal users, by the way, can get access to these charts and many more, of course, throughout the show at GTV. Go on the Bloomberg Terminal. Something else to tell you about as well. We're going to be examining the future of European defence in a webinar later today. Of course, we've seen that run up in European tech stocks. Scan the QR code to join that discussion, where military investment, of course, is increasing. We'll be asking where the region stands on force readiness, integrated command and control and coordinated procurement. All of those things have to be addressed. That's at 3:30 p.m. UK time. Scan the QR code to get involved. There's plenty more coming up. The opening trade is up next. They're going to walk you through, of course, all the geopolitics, the Middle East in focus, the oil markets, and give you a preview of what to expect from the Fed. Stay with us. This is Bloomberg.